Hey everyone, welcome back to Corporate Decoder. Today, Toyota Motor Credit Corporation just filed their annual report, a 10K for the year ending March 2026, and I am seeing some interesting shifts in their business. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company's net income is up significantly. But a closer look at their loan portfolio and how they are funding themselves shows us where the real story is. So Toyota Motor Credit Corporation, also known as TMCC, is the financial arm of Toyota. In the US, they handle everything from car loans and leases for customers to financing for dealerships. They also offer protection products like extended warranties. This latest filing, their 10K, covers their fiscal year up to March 2026. Let's dive into how they did. Their overall net income jumped to $2.3 billion in fiscal 2026, a nice bump from $1.7 billion in 2025. This increase was driven by a few key things. They saw a significant decrease in interest expenses, which is great for them, meaning borrowing costs went down. They also had a solid increase in their total financing revenues, bringing in more money from loans and leases. Their provision for credit losses also went down, meaning they are expecting fewer defaults than before. Breaking down the finance side, this is where the bulk of the money comes from. Net income from finance operations alone was $1.8 billion in 2026, up from $1.3 billion in 2025. This was boosted by a $306 million drop in interest expense and a $282 million rise in total financing revenues. That is a pretty big jump in earnings from what they actually do financing cars. Looking at where that financing revenue comes from, operating leases made up about 25% of the total. Retail contracts were around 64% and dealer financing was 11%. The revenue from operating leases and retail contracts saw a small increase, which is good. But dealer financing revenue actually dropped slightly. This tells us they are doing a bit better with individual customers than with the dealerships themselves. Scroll vehicle e-financing volume e-scroll, but here is where things get more interesting. While their total financing revenues are up, the actual volume of new contracts they issued dropped quite a bit. In fiscal 2026, their new retail contracts were down 10% compared to 2025. Lease contracts saw an even bigger drop of 26%. This is partly due to something called the Mazda Financial Services transition, where they shifted some of their Mazda contracts to Toyota Financial Savings Bank. While this might streamline things for them, it means fewer contracts directly on their books. Their market share of Toyota and Lexus sales also dipped slightly. On the dealer financing side, it is a bit of a mixed bag. While they saw an increase in their dealer financing assets, this was mainly driven by real estate and working capital loans, not necessarily more wholesale inventory financing. This suggests they are sticking with their proven real estate and working capital business with dealerships rather than aggressively expanding wholesale financing. Now, let's talk about risk. TMCC is always watching out for credit losses. Their net charge-offs as a percentage of average finance receivables actually decreased to 0.8% in 2026 from 0.86% in 2025. That is a good sign, showing they are managing defaults better. Their average loss severity per unit also went down. This means when a default does happen, the amount lost is a bit less. This is likely due to their efforts in refining their purchasing and collection activities. Reflecting this improved risk management, their allowance for credit losses actually decreased to $1.5 billion in 2026 from $1.7 billion in 2025. This is a positive trend, indicating they feel more confident about the quality of their loan book. How do they fund all this? TMCC relies heavily on borrowing money, and they have a massive amount of debt. Total debt was around $125.2 billion in March 2026. While this is a slight decrease from the previous year, it is still a huge number. The interesting part is their debt to equity ratio, which improved to 7.0 in 2026 from 7.4 in 2025. This means that while they're highly leveraged, they're managing that leverage a bit better. A big chunk of their debt comes from unsecured notes and loans. They issue commercial paper, which is short-term borrowing, and also medium-term notes. Their average contractual interest rate on unsecured debt was 3.93% in 2026, a slight decrease from 4.08% in 2025. Which helped lower their overall interest expenses. They also use secured notes and loans payable, which often come from securitization deals. This means they are packaging up loans and selling them to investors. This type of funding decreased slightly in 2026. Looking at their balance sheet, total assets remain stable around $155 billion. What stands out is their cash position. Cash and cash equivalents decreased to $7.7 billion in 2026 from $10.7 billion in 2025. While this is a drop, it is still a healthy amount of cash to have on hand. Their debt is still very high, but their equity has grown, improving their debt to equity ratio. On the voluntary protection side, which includes things like extended warranties, revenues increased by 9% in 2026. The number of contracts issued also went up, showing growth in this area. Net income from these operations was $488 million, a significant jump from $330 million in 2025. This segment seems to be performing really well for them, contributing more to the bottom line and showing consistent growth. Finally, a quick look at fair value measurements. This tells us how they value their assets and liabilities. Most of their investments and derivatives are valued using level 2 inputs, meaning they're based on observable market prices. However, their finance receivables, which are their core business, are classified as level 3. This means their fair value is estimated using unobservable inputs requiring more judgment. This is common in lending, but it is always something to keep an eye on. So, what is the story here? TMCC is a highly leveraged company as expected for a finance operation. They are successfully growing their net income, driven by stronger financing revenues and lower interest expenses. The voluntary protection segment is a real star, showing solid growth and profitability. The main challenge seems to be managing the volume of new contracts, which has decreased partly due to strategic shifts like the Mazda financial services transition. They are also managing credit risk well with lower charge-offs and a reduced allowance for losses. The big question remains how they will manage their massive debt load even with improved ratios, especially if market conditions turn south. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description.